Mo. So great to see you.
Great to see you too, Rob.
I was looking back, and last time you were on the podcast, Jeff, if I can take you back, it was early April. I think the VIX was close to 50, if not just slightly above. And at the time, the world was certainly reeling from a certain trade policy announcement that had just come out. And so today, just looking at broad market indicators, that all seems pretty far behind us, at least in terms of where markets are. They bottomed in April. And if you're up for it, what I'm hoping we can do today, without making any macro predictions outright, from somebody who spends most of their day looking at US companies in the small and mid-cap space, are there things that we can glean about some bigger picture economic aspects that maybe bubble up from the bottom up? And one place I thought we would start is just with respect to the consumer in the US, obviously a massive engine behind the US economy and the global economy. What are you picking up from the companies that you look at, from some of the comments being made, the outlooks, the guidance that might suggest anything that we can glean with respect to the health of the consumer?
Yeah, Rob, I think the consumer is doing, I would say, still moderately well. And this might be surprising because I think the commentary in mainstream media is that the bottom is falling off, or that certainly something kind of really severe is happening with the consumer. But when we look bottom up, when we look at kind of consumption numbers statistically across a broader macro set, of course, obviously, assuming that we can get the numbers these days, given the government shutdown and some of the delays there. But from the stats, we can see consumer spending is still generally positive every month, every quarter, kind of year over year. And then when we look at the companies that we invest in or are interested in investing in, I would say generally the consumers they're not robust. I will not say things are growing rapidly, but if you have good products like Shark Ninja, which has been kind of a top holding for over a year now, if you have innovative products like them, consumers are still willing to buy their products, and they're still growing kind of in the mid-teens or better in any given quarter. We're seeing probably more weakness in the slightly lower end consumers. And there it's just, I think, a combination of historical inflation and then wage rates not quite keeping up. And so for them, I think there is, I call it a bit of a bifurcation where there's more deal seeking, there's more stretched budgets. But that helps some companies like Murphy USA, which is a holding of ours, and they serve, they usually are the kind of the cheapest gas station in the area that they operate in. So when consumers trade down, they're kind of helped a little bit. But overall, I would say the consumer health is, at least on a bottom-up basis, we're not seeing that kind of five-alarm fire that maybe some of the mainstream media articles might suggest.
This K-shapedness that you alluded to with respect to lower income segments having a tougher time than maybe other segments, does that observation drive any research priorities for you? I know you mentioned a couple of companies, but just thinking about how you look at ideas in the space and their developments, how do you take that into your process?
I would say at the margin it does. Certainly, if you're looking at two companies that seem to have similar competitive advantages in terms of the strength of the advantage, if the DCF valuation looks broadly similar when you do your Monte Carlo analysis, you would bias towards the company that operates in a environment or market that is a little bit more robust. So we've been looking at kind of travel, for example, because that still seems to be relatively resilient, whereas we did exit a retailer a little while ago now. I guess it was before all this happened that served kind of the lower end consumers in America.
Okay, just as some of those signs were emerging. Another thing that's maybe more company specific, but again, something you said earlier had me think of this, just with trade policy and tariffs. One of the thoughts has been that just, hey, if a company produces or provides a good or a service that their customers really need, they'll have the pricing power to pass that through. What have we seen in terms of pricing power or margin dynamics? Anything notable there that you think is worth sharing?
Yeah, I would say that pricing power generally follows what you would assume about the strength of the competitive advantage. I think I would say in some cases, this would be probably less so around tariffs, more so through that inflationary era we saw in the last couple of years, where if you have, because remember, like overall inflation at one point was running kind of 6-7% for a quarter here or there. But that could mean underlying certain commodities or certain products, intermediate products are maybe going up 10-20%. So that's a lot of price you have to push through. That would create sticker shock for your customers. And the companies that are able to do it clearly have strong competitive advantages. So a company like Amphenol, which makes interconnects and sensors, um, they have kind of maintained and actually increased their margins over the last 3 years, whether the inflation caused by the tariffs or whether the inflation just from kind of the inflationary era. Um, they've done really well. I mean, partially, I would also caution to say that they are exposed in one division to kind of the AI data center build out theme. And so that naturally has a bit of a higher margin given the complexity of the products there. But generally speaking, when you read management's commentary, they're talking about pretty robust margins all the way through. So generally speaking, I'd say at least the companies we look and focus on, they have been able to pass prices through, whether it's from the tariffs or from kind of historical inflationary era. And margins, for the most part, I would not say they're at kind of peak in terms of their ability to manage margins. I'd say a few companies have started to see their margins roll over a little bit from kind of the peak during the mid part of the inflationary era, but generally still healthy. And in most cases, actually, margins are higher than they were pre-COVID.
Certainly, corporate profits have been an area of strength. Um, One, I assume you'd agree with that. But then second, there's the results and then there's the market reaction. One feeling I've always had with respect to the US mid cap space, and again, feel free to disagree with me here, was just that um, reactions are pretty swift in the mid cap space and often pretty outsized to either better or worse than expected news. Have we seen that continue even with broader, better earnings overall? And are there any pockets where you're noticing, again, either for better or worse, major disappointments or major beats?
Yeah, I think reactions are still quite outsized, to your point. And well, we just had to look at kind of payments companies recently. So it's not a company we own, but I joked it's a day when technically the largest or one of the largest payment processors in the world became a mid cap company. Fiserv dropped 45% in one day on earnings. So and I looked at the results; they were weak, but if I remember correctly, the market or the sell side was expecting maybe high single digit organic growth, and they came in at low single digit and gave a more moderated guidance because of that. And yeah, the stock was down almost half. So absolutely, I think that dynamic has continued where markets are very volatile. But I think that gives a bottom up stock picker opportunities as well, where maybe it's on one day or maybe it's over a period of time. But for example, Waters Corporation, which is a maker of life science tools, mostly for pharmaceutical uses, things like liquid chromatography machines or mass spectrometers. They made an acquisition. So in this case, not earnings, but they made an acquisition of some assets from Becton Dickinson, kind of essentially buying their life sciences division. And the market didn't like the deal. The stock was down probably 25-30% from kind of the pre-announcement to the bottom. And we analyzed things, and to be fair, we also thought they probably paid a pretty full price for those assets, but not it wasn't so bad that the company it's overall deserved to trade down 30%. And so we added to our position. We actually kind of, as an example of teamwork, this is a company owned in both a global equity strategy as well as our US all cap strategy as well. And so kind of the teams huddled together. We kind of shared our learnings. We talked to management a few different times, kind of model it out through the Monte Carlo process. And we decided, yeah, it's kind of statistically cheap now. And since then, the stock has kind of basically recovered all of the drop. And that's an opportunity for an investor like ourselves that can take a longer term view and have a more maybe nuanced way of looking at valuation rather than just being driven by psychology and momentum.
I definitely want to come back to valuation and your thoughts on that a little bit later. But shifting gears a bit, capital expenditures. We had Grayson on the podcast maybe a month or two ago. And one of the themes that I took away from that conversation was just how massive the current CapEx cycle that we're in. Of course, a lot of this tied back to AI. It strikes me as quite different than, again, when you were last on the podcast, where, there was just such uncertainty. And I think one of the things that we were getting from management teams at the time, I think Jamie Dimon said something similar in this regard recently, which is basically like, hey, when it's foggy out, you drive slower, was just this notion of caution, perhaps amongst management teams, that with uncertainty out there, would investments slow down? Can you reconcile, this massive amount of CapEx on the one hand that we see on the AI side with this notion that, hey, there still is uncertainty out there? And is it still the case that in many places, management teams maybe are a bit more cautious with respect to how they're allocating capital?
Yeah, I think that makes sense in theory. We're not seeing a lot of that in practice, especially in the mid cap space, where a lot of these companies probably, especially the ones that we're more focused on with competitive advantages, they probably tend to have more opportunities to grow. Putting kind of AI CapEx aside, which has been a great and huge driver of activity and has really been kind of driving the economy in the last probably kind of year and a half. But when we look bottom up and look at companies maybe only peripherally exposed and not exposed at all to the AI data center build out, we are still seeing companies, whether it's a retailer opening new stores or companies building new manufacturing facilities, OSI Systems, which is the world's largest border scanning and cargo scanning equipment maker. They have, they continue to build more facilities because demand is at record levels right now, not just in the US, which as you might expect given the current administration's focus, but also in many other parts and jurisdictions around the world. And so I think companies that are well positioned and are competitively advantaged, they continue to spend and meet the demand that they see. I mean, the economy is still growing. The unemployment rate, I think a lot has been made about kind of incremental hiring maybe is a little bit weaker recently. But you have to remember, like, unemployment rates have been near kind of historic lows for like 3 years now since kind of that COVID spike kind of normalized. And so generally things are like relatively healthy. Yes, I think some people have shown some statistics. If you like completely X out all AI investment at all, the US economy is like flat or maybe slightly in a recession. But I mean, if there was nothing to be done in AI, I would imagine that money would have gone maybe somewhere else. For example, a theme that I think has actually been delayed slightly because of the AI build out is reshoring. So just one example, kind of pharmaceutical companies, they've made more CapEx announcements in just the past 12 months than they've spent in CapEx over the last decade in the US. And so, I mean, some of these announcements might not come to fruition and so on, but I think partially because of the Trump administration's desire to reshore and some of the kind of pricing dynamics and discussion that were had between major pharma companies like Pfizer and the Trump administration. So that drove some of it, but a part of it too, I think, is just a desire after COVID for supply chains to be tighter, and this recognition that if you have all your precursor ingredients and supplies being made in India or China, and then global pandemic hits, he might not be able to access the right drugs in a timely manner. So that would be a great example of a reason to reshore, or TSMC and Intel building kind of semiconductor fabrication plants in the U.S. And there's kind of general manufacturing onshoring, not just because of tariffs, although tariffs are probably accelerating that, but also because of the learnings of the pandemic. Just supply chains got a little bit too stretched globally, and one way to kind of manage that is to have more localized manufacturing. And I think things like robotics, there continues to be advancement in that. And so the gap between kind of offshoring to a lower labor locale and just having more automated factory in North America, that gap continues to close. And so, yeah, there's a lot of themes driving it. And sorry, the reason I'm saying some of these things are delayed is when we look at some of these engineering companies and call it HVAC installers, electrical installers, they're all backlog out like 2, 3, 4 years in some cases, which is crazy because when I looked at these companies pre the AI boom, like they would have like 3 months of backlog, and that was like a good situation for them, or 6 months maybe. Um, and
But you're saying it's not just the data
correct,
centers for which
there's
there's demand. It's actually quite a bit
it is,
broader than
yeah.
that.
And for example, if I'm just a mid cap company that wants to build a new like ball bearings plant in Arkansas or something, and I need to install some electrical wiring, we call it electrical contractor, and he's like, yeah, well, I'll do it in 2028 for you because all my AI guys are paying me top dollar to install electrical wiring in the data centers, and you can't afford to pay me top dollar to run basic cable in your ball bearings plant. So things like that, right? Where I think the AI boom is actually backing out a little bit of other investment, and so I don't think, absent the AI boom, that the economy is in recession. I know. I think I've read a couple mainstream media articles about that. I personally don't believe that.
Have there been many adjustments to the portfolio as a result, Jeff? Like, has this dynamic shifted the way you mentioned those HVAC companies? Whether it's them or others, has this shifted your thinking or created investment opportunities for you?
Yes and no. Ultimately, it's a bottom-up stock selection process. Being macro aware allows you not to overly concentrate in areas that could have pitfalls. Or earlier, we kind of made that comment, or well, you have two companies, maybe call it exactly the same in terms of competitive advantages, in terms of valuation. I mean, I know no two companies are exactly the same, but one serves the low end consumer, one serves maybe the medium high end consumer. You kind of you have bifurcations, and you would make trades like that, or make review things like that. But maybe a company like ITT, which we more recently added to the portfolio. And that may have been driven a little bit by the fact that they're operating in a reasonable environment. So ITT is kind of an industrial conglomerate. Um, and they, one area that they call it industrial processing. So they have things like motors and kind of bearings and kind of different little products that go into other industrial equipment. And they have done a very good job under the new CEO, and sort of kind of, well, newer CEO. He's been around probably 5-6 years, but they've done a good job of kind of turning around their operations, increasing margins, starting to go on an acquisition path, and then starting to turn around those acquisitions. So primarily it's a bottom-up story around decent competitive advantage, a strong management team, and a lot of runway. But a lot of runway, an aspect of that is our view on the end markets they operate in. So I would say that's always how macro plays a role in the bottom-up process. So it's not 100% bottom-up, but it's primarily bottom-up.
Just to stick on that bottom up theme, we've talked rather thematically so far, and I have just so appreciated how you've woven in, these aspects of just company by company, what you actually look at. So instead of asking you a question that's more thematic in nature, I want to ask you a real bottom up one directly. Just specific companies or industries. What's got you really excited today that you picked up on? Whether it's because some market dislocation has happened that presents an opportunity, or like you said, it could be just a new or newer management team that just makes all the difference in a business. What's really exciting in the portfolio today?
I find defense really interesting right now. And I know that industry has gone through its kind of ESG roller coaster of a journey. Um, the internal view at Mawer is as long as the products and services help to prevent wars and prevent further death, that's probably net value add to society, especially in a global environment that's much more open to conflict or to initiating conflict, I should say. And I point to probably our current top holding, CACI International. So they're a US IT defense contractor. And the bulk of the business today is still what you would imagine an IT contractor does. They would go, except in this case, for the Department of Defense or the various branches of the military, they would go into the Air Force and help them implement an ERP system and move to the cloud. To help the Navy have a system where kind of naval command can communicate with the ships in a way that's very secure and seamless. So they'll do projects like that. But over the last 10 years, this management team in particular has done a really good job of pre-positioning the company in emerging technologies. And after the Russian invasion of Ukraine, some of those emerging technologies emerged. So they have, I'd say probably 25% of their revenues now are coming from businesses that I would count these kind of emerged technologies, if you will. Most prominently, counter UAV. So kind of jamming drones and forcing them to fall out of the sky. They would have some of the technologies to do that. I think in one case they can carry that thing around in a backpack as an example. They also have technologies to allow for more secure and unjammable communication. So you probably heard about kind of RF radio frequency jamming going on in the Russian-Ukraine front lines frequently. So the U.S. government has kind of seen that and recognized the weakness of call it radio communication or just kind of general RF kind of communication through Wi-Fi and so on. And so they're helping the U.S. government build out a optical communication network. So optical, visual, so using light, and it's really cool. I don't know the full technology. In my mind, I'm imagining like a very sophisticated kind of Morse code style communication where you just kind of flashlight at each other, and you kind of communicate that way. CACI has talked a little bit about it in the public domain, but there are some things classified, so I don't know exactly how this technology works. But things like that, right? Where 10 years ago they started investing in this, and today they're the leader. In fact, I think they're the only. I read somewhere, I don't know if this is true or not, but I think they're the only U.S. Provider of counter drone technologies to the U.S. military. I imagine that over time, other companies will do that too, but this show gives you a sense of kind of their lead.
Long-term thinking, positioning a business for the eventual threats that might emerge. Great. Well, I do want to ask you one last question, Jeff, and I'm going to pull us back up to more of the top down. I promise to come back on the topic of valuation. Certainly very topical in markets lately. We usually hear that, though, I think, to your comments earlier about just, mainstream media, it's often in the context of the S&P 500, largely lately with respect to AI beneficiaries. Can you speak to valuation more generally as you see it across the U.S. landscape? And in particular with respect to the mid-cap space where you're focused?
So I would say valuations are actually decent in the mid-cap space. It could be because mid-caps, I'm talking as an index now, has underperformed large caps for several years, for being generous.
And more recently, I think it's underperformed small caps too, right? They've been
That's true.
sort of
It's true. Small caps have recovered, but mid caps have generally kind of stayed flattish. And so I would say, yeah. So I'm just looking at kind of numbers on the rest of mid cap. I'm seeing, this kind of mid-November when we're recording this podcast, I'm seeing kind of 21 times trailing and 17 and a half times forward PE. I would say for the health of the economy, for kind of what we're seeing in the macroeconomic environment, that seems like reasonable valuations. they're not cheap. I've been around long enough to remember kind of high quality companies trading at 10 times PE back in 2009. But they're not crazy expensive either. Um, and so I think so much attention and probably passive flows have gone toward large caps. And then to your point, I think recently there's been kind of a narrative that, oh, small caps have been left behind. And so some money is kind of flowing into small caps as well. But the mid caps are kind of just hanging out there and going, oh, what about us? And yeah, like we're happy, right? Because we can continue to deploy capital into great companies at pretty reasonable levels of valuation. And when we do our discounted cash flow models, as you know, we come up with kind of implied internal rate of return for the kind of price that we're paying. And generally, we're looking at kind of 9% perpetual returns, in a few cases even 10%. So I would say that that's pretty robust. That's kind of the century-long average for the S&P 500, right? Or the Dow Jones, I think, is the one that goes back that far. But yeah, I'd say things are looking decent on valuation. You have pockets of things that are expensive. I think many stocks that are very obviously exposed to the AI theme are, at least on an optical basis, kind of on a PE basis, looking pretty high in its price earnings ratio. On occasion, if you model out the company and you have some pretty robust assumptions for the next few years, they can still make sense. But by and large, and I believe our portfolio probably is underweight AI, although AI is a little bit harder to figure out right now. There's no sector in GICS called AI. AI could be anything from installing electrical lines or pouring foundations for data centers to, NVIDIA and the chips and everything, all that kind of complex that people understand and naturally attribute to AI. But yeah, I think the valuations are pretty robust there, and we certainly have been finding it a little bit tougher to find kind of good, well-positioned companies with kind of long-term longevity there. But putting that piece aside, I think everything else in the market looks quite reasonable. And in fact, a few places they're starting to look pretty cheap, maybe because people have kind of overlooked those areas because of this AI kind of investment theme.
That's a bit of the theory behind the strategy, right? It's less concentrated thematically, more focus on this vast array of companies across industries that perhaps many of us haven't heard about. Not necessarily the smallest of caps. We still want companies with established competitive advantages, but sort of under the radar. And I guess it sounds like today, with the added bonus of perhaps valuations that are relatively more attractive than in other parts of the market. So Jeff, appreciate the tour today. I know we covered a lot of ground. And really appreciate all the work you do for us and for our clients.
Thank you for having me on, Rob.